All right, welcome everyone. Um, these have become kind of fun for us, and so today we thought we'd do it a little bit different. We sent the memo about worry out a couple of weeks ago, and it's sort of spurred conversation in the firm across all our advisors, and we've certainly had a bunch of conversations about it. So I thought what we'd do today is kind of give you a glimpse to some of our conversations and talk a little bit about what started it and why we went here and what we're doing about it. So as usual, if you want to ask questions, use the Q&A. Feel free to do that. I know many of you are going to watch this on recording, so hopefully the things we'll cover will help you that way. And then we'll get going. We're just going to kind of ask each other questions and talk about what we've been talking about together, and we hope you find it useful. So, gentlemen, shall we?
Yeah. So I guess going back to the beginning, why did we start with worry, Nate? Why did we choose that as the topic for today's webinar?
Yeah, it's a great question. I just had it on my mind, to be honest. It was sort of my thoughts as I've been talking to clients, as I've been, I think all of us now, we listen to podcasts, we read books, we're all trying to stay as informed as we can. And what was interesting to me is that we were coming off these 3 years of just really stellar market returns, and nobody was ecstatic about it. The general feeling among people in conversations, whether it was casual at a party or friends or watching a sporting event with your kids, it just seemed like everybody had anxiousness and worry about the economy, politics, whatever. And so I was like, man, for how good it's been,
Yeah.
it just feels like people were really worried. And so I was like, I think I want to put some thoughts down on paper, and especially when we get into some of the questions like how we normally react to that and what we do. I thought maybe this would be a better way to think about it. So that was kind of the genesis. So maybe with that as a starting point, you guys can bring up some of the things. What are some of the concerns we've heard recently in our client conversations? Maybe we pick the top two or three.
Yeah, I'd say there's been a lot of talk around, this AI bubble, or the potential of some bubbliness frothing over the last year or so. So I'd say that's definitely been one of the main talking points over the last couple of months here with clients, and not just clients, wholesalers, and some of the partners that we work with here too. There's a couple of things that might cause some of that anxiety around, the AI bubble. One of the things that we've been seeing a lot of in the news cycle is, some of the circular investing where NVIDIA is funding projects for OpenAI. OpenAI is then buying compute from Oracle, who's then, funding, some projects for Perplexity, another AI company. There just seems to be a lot of kind of giving between companies, and I guess that makes us a little bit wary. Going back to kind of the
Well,
2000 time.
I think the big deal was that they're promising like sales and purchases
Right.
that are way bigger than their current revenues, right? So that
Correct.
hits the news and gets everybody anxious.
Yeah.
Uh, we kick it around a lot in here. Is it a bubble or isn't it? I don't think it matters for the long run, which I'm sure you thought we would say, but there are some interesting differences. The companies that are involved have significantly higher profits today than they did in the year 2000. But yet there's this very bubblicious behavior in the AI side. I actually think that the AI bubble might affect more of the companies that people haven't heard of, things like HVAC companies and construction firms that are building data centers. Some of them are having stellar results because they're putting a massive amount of infrastructure together to build this compute. Oracle has had some pretty big stock movements recently, and that's all come back to earth. That kind of was a whole circle of great results based on this thing, and then everybody being skeptical. And as they always say, it's not the known things that get you, it's the unknown things. And so I have no idea if that's going to be how this works or not. But it's interesting that certainly the AI bubble has been one of the things that maybe is adding to the worry for people as we go along. So that's a good one. What about some other stuff we're hearing?
Sure. So I think an obvious one, because we're so inundated with social media and just news cycles 24/7, 365, is politics and, the current administration and how they're dealing with the Fed, if you will. We've had tariff tantrum earlier this year. And so that's sort of an ongoing thing, but because of the world and where it's at today and the access to news and information, it just seems to be like omnipresent, if you will. And it doesn't matter what side of the aisle that you're on. With talking with clients and conversations, we hear different perspectives. And what it usually leads to is, worry about some shoe that's going to drop at some point in time, and the world's going to, quote unquote, be different as a result of this. And that's a huge thing that I think comes up. We don't really dive into it, as you know, I would say, for what we do here, and we're by no means experts in that arena, but it's just something that we hear a lot from families and friends and clients.
I don't think we would ever take a side. You probably know us better than that by now. But what I find interesting is the leap from whatever political worldview you're on to the economic disaster associated with it. And it's kind of equal on both sides, which
Yeah.
can't possibly be true. Can't have both of them causing trouble from the opposite perspective. But we do hear it a lot. And I think just the nature of our politics, the way our discourse has devolved, we're in two camps, we're not very nice to each other about it. I think it adds to that anxiety. So I think that's a big part of it too. It's a good call.
For sure. That's a big one that we hear about.
Yeah.
That kind of segues into, like, you know, national debt as being another one that's correlated with that, right? Like we have that coming due in March 2026. Heard that from, you know, various clients, you know, kicked around, and also, you know, economists and market strategists as well, is like that could be a big thing that's a worry out there that we've heard from clients.
Yeah, this is ongoing. I think this is not new. We've had national debt concerns for my entire lifetime. We're probably going to have it forever. The current administration is bullying the Fed a little bit. What will they do about it? Will the economy grow fast enough? Or are we on a path to destruction, et cetera? We're not going to solve that today, certainly. But I think that's one that comes up sometimes as well. So we could probably find 6 or 7 other things to put on this list, but we
Sure.
thought, you know, reasonable to pull out the ones that we've heard the most. And so what's interesting is not so much the issue, but the mental mindset around it, right? How is it making you guys feel?
So I guess, you know, this level of worry that we're seeing right now, you know, how would you say that compares to, you know, 2000 when you were just getting going into the industry, 2008? You know, those are the most recent major crises. You know, are we seeing heightened levels of worry? Is it similar? What are the differences, would you say, or what are the comparisons?
Yeah, you guys noticed there that Neil just called me old in a
Ah.
really polite way with a great accent. That hurt a little, but I'm okay. Yeah, since I was the one who was around during these downturns, it's completely different. And I think that's why I wanted to write the memo. Is in when I started in the career, everyone was like, .com's going to change the world. It was mayhem. It was chaos. Everybody thought it is different this time. And then it wasn't. And then the real estate nirvana of 2005 to 2007 was equally manic, where you just had, you know, people were buying interest only loans without stated income. And there was never a chance that you were going to get cash flow positive on that rental property. And the whole game was that someone else was going to buy it for more money later. And then, of course, the bottom fell out of that. And we understand what happened with the world in the great financial crisis. I don't remember anybody being worried in those moments. In fact, they were irrationally exuberant. And yet all the data now is like, hey, look at the valuations, look what the stock market has done. And it's so similar to these previous bubbles, but the sentiment isn't anywhere near that. Now, this is not scientific, and you certainly can't take this as prediction, but most bubbles burst when people are euphoric because they don't think there could possibly be this downside, and then there's a really big downside. That doesn't mean we can't have a downturn, doesn't mean this is not a bubble, but it is just different. The anxiety and the worry this time around does not seem to match the results. If anything, as advisors, I almost worry about mania worse, because that's pretty dangerous. You know, the fear of missing out could be really powerful. And we're not seeing that. I mean, when was the last time we had a FOMO conversation with somebody?
It's been a minute.
Which I'm grateful for. Good for you guys. Maybe we've got you trained. But that is really interesting, because it was really like, this time it's different. The world is amazing. It's going to go nothing but up from here. And of course it didn't. And that's not the sentiment at all. And you're certainly not getting that in the media either. So no prediction, but just interesting when you think about it. I think it's probably a good transition when we talk about what clients worry about to what are we worried about, right? What are your financial advisors worry about? And Cody probably is the best at this on our team. He talks about this a lot. You know, Cody, if I was to like say, what's our top worry as a financial advisor for our clients longer run?
Yeah, I think you get to the bottom line, and why we work with you guys, and why we exist, is to have you not run out of money in the long run. And so quite often I think clients get fixated on a number, or the language that we're at all-time highs and it going down. I think the natural human response is, you know, you're more risk adverse, right? You will react, I forget what the stat is, like several times more to market downturns than the market going up.
People generally are more fearful of loss than they are happy about gain. It's a behavioral finance thing.
Right. Which leads to sort of like over tinkering or trying to time markets or trying to guess what's the right move to do ahead of time. And, without, proper planning and whatnot, you get sort of the stuff set up to help prepare for that. But I think the biggest concern for us, like I said before, was that, not running out of money. And there's this thing called inflation, and it's the rising cost of living over the long run. That in our mind, or my mind, really is like the greatest risk at all. Missing out on all those great days in the market for the long run, trying to do something different within your portfolio can be very dangerous, if you will. And so that's why we exist, is to help, manage people's portfolio for their life for the long run. And I know I'm concerned about, keeping up with that. And that's a huge thing, I think, at the same time.
Yeah, I think because I'm a professional summarizer, I don't actually have any value on this team other than to summarize my teammates sometimes is I think our clients worry about volatility as risk. So I had $1 million and went down to 800,000. And we worry about long-term purchasing power. So what is that supposed to do for you over the next 30 years? And when we spend time in the software and start modeling out what it's going to take to do that with all the things that you can't possibly see coming, that's probably the bigger worry for us, which is why we don't get so worried about the short run. It's a good way to transition out of that and just say, why are we worried about worry? Like, why do we care about this? And I thought that was funny because we just said worry a million times, but also like, why does a financial advisor care about this? Well, it turns out like our purpose here is to enrich lives, and it doesn't feel like it's a very rich life if you're spending time on what should be your financial independence, worrying about what's going to happen with your money. So Neil's actually got a health background, and just thought I would throw a little bit at you, like what's some of the stuff that happens when people are anxious or worried, and why we care about it, because it actually affects your life.
Sure. Yeah. I mean, there's a plethora of studies out there that will show, increased anxiety, to potential health, down, or I guess, potential health, I don't want to call it defects, not, what's the word I'm looking for?
Yeah, it's just
Detriments to your health, right? Worrying and being anxious and, increased stress, can lead to depression and, can lead to things like insomnia. There's a plethora of studies out there that have come out about that. And I think we live in a very anxious generation these days. Again, there's a lot of research out there that dates this back just to 2008, when the first iPhone came out. People's screen time has increased over the last 15, 20 years. That, we live in a constant contact generation. We're getting information instantly. Our screen time has increased since the early 90s, even the early 2000s, because of this device that we have in our hand at all times. So, there's a lot of research to say that, hey, the more anxious we are, the worse it's going to be for our kind of health and well-being. Well, what are some ways that we can kind of limit that? We're not health professionals. We're not going to get into kind of solving that. But, I think it's a good reminder to think about how much time are we spending absorbing a lot of this information. Social media, for example, wasn't around in 2008 or, in the early 2000s. It is now, right? Everyone lives on it. So there's just a lot of things that are forcing us to kind of almost live a more anxious and worried life. And it's hard to get away from these days. So, we don't want our clients to have, detrimental health effects, right? Because of this worry, not at all. But we just need to acknowledge that, these things are out there. And it's our job to, hopefully limit some of that.
But I think it just takes away from you being present in the moment and spending time with family and whatnot, because you're so worried about all these possible, shoes that could drop at some point in time too. So I think
it steals your joy, right? Worry steals joy. And I think where we might make a mistake is that we're super quick to just be like, hey, let me show you some stats of why you shouldn't care about this. And maybe we should probably rethink that. And some of the reason for writing the memo and for doing this town hall is to talk about that, because I think we first need to start with an apology, because we're ready with charts and graphs, man. We got our stats. We're excited about why the markets will recover from whatever it is. But I think first it's like, hey, a metaphorical hug. Like, I get it. It's stressful. There's no part of us having this discussion that will make that anxiousness and worry that the world brings us go away. But could we do something that helps you put it aside where it isn't really impacting life so much? Because it would be a shame that it creeps in when you really should be having that joy that Cody's talking about and being present in the moment of all these great things. You have a limited time in life, and we want everyone to live it to their fullest. So the first thing is like, hey, just an apology that we probably are too fast to deploy our stats and figures. In fact, we'll kind of kid around with it here. Like we've got some favorites. What are some of the favorite ones that you guys have probably heard us pull this out at a moment when we talk about downturns in the market?
Yeah, I mean, a very basic one is that, the average bear market is, once every 5 years on average, 5 to 6 years. So, we've lived through this before. We will live through more of these in the future. We can get through it, but that's a classic stat, if you want to call it that.
I've used that. I'm guilty of using that for sure.
Yeah, one that is so easy for us to say, it's time in the market, it's not timing the market, right? Again, when we fear these take April, for example, the tariffs, right? Making rash decisions and thinking, hey, the world's going to end here after, just 10 days, all of a sudden, there's a change of heart in the administration and it goes completely other direction in a couple of days, right? So, not trying to time the market is obviously a key one. You've all heard it before. But, sometimes it's too easy for us to just, pull out these quotes and say, hey, don't worry, just listen to us, and things will be okay.
Yeah, we just threw some stats here. Like I know I've done this before, and certainly in COVID when we had time and we were sitting at home trying to have conversations with people. I was like, oh, well, look, the markets are up 10x since the market bottom of 2009. They're up 3x since COVID. They're up 85% since even 2022, which everyone's already forgotten about that bear market that was just a couple of years ago. All of these things that these guys just said, they're all true. They're all useful and helpful. They're not incorrect. But I think what we would like to do today is just kind of take it back a notch and go the other direction. Instead of starting with those, which are true and can be relied upon and really do work, I think what if we just lean into it? Instead of trying to ignore the worry or distract you from the worry with stats and figures, what if we just lean in and say, hey, well, what if that thing really happens? And that was kind of the point of the memo we sent out. So let's pretend we're going to act here for a moment as if we had a really big downturn. I don't know if it's 2008 style or something pretty significant. What can we do today to plan for it, hopefully ease everybody's mind, and then we feel like we're prepared going into things that we can possibly predict. So where do we start, guys?
Yeah, I mean, it starts for us, it all comes down to cash flow, right? So, do you have the money set aside that you need to live the lifestyle that you want to live, and you can continue to live for, the next 3-4 years, right? And for you guys who have worked with us for a long time, our buckets of money approach. We have that short duration bucket. That is that's your monthly expenses, right? What other layers of safety do we have built in that can aid with that cash flow? Do I have everything that I need to kind of sustain my lifestyle through a potential downturn if we were gonna, walk into one of these? And that's really what it comes down to. A lot of our planning is cash flow based. I'd say it's all cash flow based, right? And we kind of work our way backwards from there.
And it's a conversation, right? We need you to tell us what's going on too.
Yeah.
So the more we know about what's coming, we can be set up for it. I think a thing that kind of goes with it in a downturn, there's always something you don't expect that could happen too. So this is where that, what's the size of the moat around the castle, right? How much safety is there? If you're going to have something bad happen, it's probably going to happen to a loved one or a family member or someone you care about in a moment of economic strife. So maybe it's something you weren't planning on as part of your financial plan, but now all of a sudden you want to help with that. Do we have the ability to handle that? And if it were the case, I think you spend too much time on it, you'll stress out too much. But knowing that those things are possible and how your plan can handle it will help as well. So those two things, kind of the base of the pyramid. If we get that right, we can weather a lot of storms.
Sure. And to kind of piggyback off that from cash flow planning, we ad nauseum, talk to everybody about understanding what it takes to live life the way they want. And one of the things I noticed in like the most recent downturns is, I don't know if you want to call it like dynamic spending, if you will, but what are the levers we have to pull on? So it's one of the reasons we focus so much on what does it take, to live, again, the life that you want, and what happens in those moments and what can we adjust. It gives you some power, some flexibility when the spaghetti does hit the van. For example, like in COVID, people were not traveling everywhere extravagantly. We built a lot of people's plans on some pretty healthy vacation and travel budgets at that point in time. And we noticed people did sort of tighten the belt in those moments. And it just all depends on what's important to you. And so there's ways, you want to hedge for that too. So that's a way of preparing, for worry.
I think the way to think about that, it's unfortunate to do planning right now to say, hey, if the market turns down X%, I'm going to cut my spending X%. That doesn't sound very joyful.
Yeah.
What I think really could be realistic is these are things that we're doing that we probably just wouldn't do. Like, we know ourselves in that moment, we are going to feel that level of anxiety. So we're just going to cut back on those things. And what that allows you to do is, in the times, because most of the time market does go up, it allows you to be a bit more aggressive. It allows you to leave that asset allocation alone, because make no mistake about it, when we build buckets of money, we are taking some chips that should be growing for the long run and putting them in a place that are out of harm's way. You're going to give up some return doing that. There's no way around it. It's the prudent move in our opinion. But if you think you have dynamic spending as part of your plan, it might allow you to stay invested a bit more aggressively, because we can't predict this stuff. Markets might roll forward for several years before you get a really big downturn. We have no idea. So I think that's why it matters. It's not a requirement, but it's really helpful to understand when we're building someone's financial planning scenario. To go, okay, we have those levers. Another one that comes up sometimes, we have people who haven't yet taken Social Security. If you haven't yet taken Social Security, I guarantee we've had a conversation about it, right? Everyone wants to know when they should take Social Security and the optimal way to do it. We often use that as a hedge in our planning. If somebody is in full retirement age, but they haven't hit age 70 and they think, oh, I'm not taking it, I'm going to wait for it to grow. 68, 69 years old, you're in the middle of a downturn, flip on Social Security, and that's a few $1,000s a month you don't have to take from your portfolio. You kind of did dynamic spending right there. So that doesn't apply to everybody. I realize that there's plenty of people who are already on it and plenty of people who are far enough away that it doesn't matter. But it is one that comes up quite a bit when we talk about this.
Yeah, that's a nice lever to pull on if needed.
Yeah. And then one we don't talk about a lot, but I'm spending some time talking to clients right now about, only because I think that people will behave better if it's already in their mind, is when would you choose to be opportunistic if we were in one of those moments? So let's take aside the short-term bucket that we talked about. And so there's we're not going to mess with cash flow for the next 2 to 3 years. That's just something that's always going to be important. But even beyond that, we typically have a diversified mix of assets in both stocks and bonds all over the place, that you could choose to be more aggressive with if you wanted to be. And I would argue that when you get these big downdrafts, they are generational buying opportunities, like 2009 to COVID, 30% downdraft really quick. And then 2022, there was a 26% decline. I actually got a couple of chances at that one. It is very counterintuitive in the moment to go take some of your mix. Let's say that we were 70% stock and 30% fixed income, and say, hey, you know what, we're going to trim the fixed income down to 15%, and we're going to put that extra 15% into aggressive equities that have just gotten hammered recently. In the moment, if you haven't sort of pre-planned this, not too many clients are excited about that idea. But realistically, if you look back, that's been a really prudent move. And so if you have the certainty of cash flow for the next few years, you've hedged the things that you want to be careful with. That is the opportunity to do that. And I like the idea of talking about, various levels down. Maybe it's 15, 20, 25. Those are all pretty major downturns that you would say, yeah, if that happened, we would move a little bit of our allocation into equities. Very counterintuitive. If you're in the midst of it and all you're doing is hearing the news cycle, because I remember 2009 perfectly, having conversations in March of 2009 with clients who were utterly petrified that the world was going to turn around or wasn't going to turn around. I had nothing that I knew of in March of 2009 that told me this is the bottom. Had nothing but bad news everywhere. And then just like a fire that runs out of oxygen, it just stops. And all of a sudden it turned around, and those opportunities can easily get missed. So I love the idea of being strategic. It also kind of takes the focus away from the worry. It's like, hey, if it happens, we're already prepared on how it would happen, and we'll try to be opportunistic on it. It's a little easier to talk about than it is to do, I suppose.
Yeah, most definitely. Talk is cheap, right?
Yeah, we might be coaching ourselves too, because we're already worried about you and your cash flow in that moment, and we need to remember that that's the move as well.
Yeah, I mean, I think the joke around the office for me is like I'm the natural warrior here, and that stems from care, right? Like everything you just talked about for a way to sort of like prepare. We spend a lot of time on people's plans, like running stress tests, if you will. Bear market scenarios. What if spending, that probably costs more than we thought? What if inflation's more than we think at the same time too? So we spend a lot of time behind the scenes preparing for that. And I just wanted to sort of make note.
Cody's our plan breaker.
Yeah.
Like, hey, what's it take for this not to work? Many times we're not showing those to clients because it's just our own internal stress test, but we do the work to really make sure we know how much room there is for error, because you just can't predict the future perfectly, right? You've seen our software. We assume 6.5% growth and 3.5% inflation. Historically, that has been a gap that markets have always outperformed, in any market cycle, whether it was 9% growth and 6% inflation or 3% growth and no inflation. At least it's a helpful tool for thinking about how to model this. It's not predictive, and it's not meant to be, but we joke Cody's our guy that we send on the mission to be like, all right, how much room is there for this to work? And once we feel like we're there, hopefully we can give you guys some confidence as we lean into that. And that kind of brings us to the end of our discussion today. We'll welcome emails and phone calls and things you want to talk about more. But we really leaned into this, but just to say, hey, we exist to enrich lives as an organization. We get this awesome career where we get to have real relationships with you and help you do what you want to do and live life the way you want to. And you're grateful for us doing it, which is a really terrific career path for us. And we're so grateful for it. As we head into Thanksgiving, I think it's probably even more gratitude than normal, is just be grateful for the opportunities we have, the people that we get to work with. And the thought that the people we care about most might be saddled with worry or anxiety about what's going on in the world. I realize it's there. We're probably not gonna be able to eliminate it totally, but maybe this discussion and just leaning in, and instead of trying to put our head in the sand and say, don't worry about that, even if it happens, it'll be okay, to actually talk a little bit of tactics on how will we do it and how are we preparing for that. Maybe, just maybe, that pushes that worry a little bit more to the background, gives you some joy and some confidence to live life the way you want to, because hopefully everybody's going to be getting together with friends and loved ones here in the next week. And there is a ton to be thankful for. And we could probably do a whole different session on that. But if you've got things that you are thankful for and you want to share them, that's always great, because I think gratitude is a fantastic place to start in life and probably for every day. So thanks so much for the trust you place in us. Hopefully you find this helpful. We're always down to talk about worry and anxiety. Even if you're feeling it, don't be afraid to do so. That's what we're here for. And hopefully this helps you with how we think about it and how we're working to keep that at bay for you. You guys have a great Thanksgiving. We'll talk to you soon.
Happy Thanksgiving.
Yeah, take
Thanks,
care.
everybody.